The nightmare scenario begins. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, liquidation risks now threaten the collapse of an entire country's banking system, which we've been warning you on the show was likely to happen, and now we're seeing it start. And the risk here isn't that it just takes down one country's banking system, that it spreads to the rest of the world. And while hope reigns eternal in Germany, we're making the case of why it's about to get much worse. And if you're wondering what we're doing in Dallas, Texas today, well, the economy there is showing a bit of a rebound, but the question is, will it last? And meanwhile, the Fed is still saying the mythical soft landing is possible, but someone else is now saying, no way. Let's over to Bloomberg, where we picked today's story up with that headline. German business outlook edges higher amid a shrinking economy. And this is what you call hope. It's because when things get so bad, when the data is so ugly, and we've shown you that the German manufacturing sector is in an outright depression based on the data, that the only thing you can think is, well, it can't get much worse. And the problem then is it is actually going to get worse. But check this out, because the expectation gauge edged up to 82.9 from 82.7, and that gets a higher outlook. After suffering a recession in the 6 months through March and stagnating in the second quarter, Germany's economy is probably shrinking again as weak global demand, inflation, and higher interest rates weigh on companies and households. Well, that is the recipe that will get you weak demand. That's the reason why the German manufacturing sector is getting worse. And that makes it the only large Eurozone country whose output is forecast to drop this year, and that's a problem is because it's just a forecast. If you look at Germany, it is the economic base, the manufacturing powerhouse of the entire Eurozone. So the idea here that Germany could collapse and none of the peripheral nations will have any problem with this is another fantasy, because if Germany goes down with a lag, watch, these other countries are going to follow. The European Central Bank mustn't test the region's economy to the breaking point, that from the governing council. Of course, we know that even though they expect consumer demand to stabilize in the coming months, the perspective that the ECB may not raise rates further, well, that will also have a stabilizing effect. And that's the issue we see here with central bankers that are looking at such lag data that they not only usually go too far, they push the economy to the breaking point. And this is what we see here in the U.S. There's a reason why we talk about the banks so much and their ability to create new money into the economy, because when you see central bankers invert yield curves, which they've done all throughout the world, it's only a matter of time before the money in the system dries up, and the next thing you know, it starts to collapse in on itself. And the whole notion is, because it hasn't happened yet, it means it won't. Well, the problem is, when it does, it's going to be outright ugly. And one thing that's looking better, though, is what's going on in Texas as the manufacturing activity is rebounding. But look at this. Outlooks are waning, and that's a challenge here, because executives, they're saying that even though things are looking better now, the future maybe not so bright. And other measures of manufacturing activity moved up this month, though some remained in negative territory. The new orders index pushed up 11 points to minus 5.2, a reading still indicative of falling demand, though not the pace seen in the last several months. Capacity utilization index rebounded into positive territory, while shipments moved up to near zero after slipping to minus 15.8. So what we're seeing is kind of what we talked about, kind of this back to school holiday season kind of bump in the economy, and then watch it slow down and roll over. But we're going to show you why the Texas economy is experiencing a bit of a rebound here and why it's not going to last. Perceptions of broader business conditions continued to worsen in September. The general business activity and company outlook indices remained largely unchanged, and uncertainty regarding outlook picked up notably, with corresponding index pushing up 14 points to its highest reading in nearly a year. So not only do you have business conditions weakening, you have, of course, outlook starting to wane. There's a lot of problems here, but what's driving the Texas economy? Less crude oil. When you look at crude oil prices here shown as West Texas Intermediate in red against the current new orders, the diffusion index for Texas, that's shown in blue. And what we can say is when crude oil goes down, well, new orders with a lag follow. But now that crude oil is headed back up, they're seeing some new orders. Yet the challenge, which is really interesting because it feeds back in to our headline story here, is that on the survey, when they asked for people's response, there were many responses saying, look, what's going on in China is having a direct impact on what we're doing here in Texas. And of course, we know that, as you're about to see in a little bit, that China's banking system is in dire shape because things there are going to get a whole lot worse real quick. But looking at Texas, they're not looking too optimistic either, as expectations regarding future manufacturing activity were mixed in September. Future production index remained positive and pushed up 5 points, but the general business activity fell further into negative territory. Most other measures were advanced into slightly more positive territory. So again, there's a lot of cautious, we'll say, optimism there in Texas. But now let's head over to Chicago. And no, we're not here to get deep dish pizza. We're finding out that the National Activity Index continues to show that the national economy is slowing down. It decreased to minus 0.16 in August from plus 0.07 in July. Again, showing a deceleration of the national economy here, as 2 of the 4 broad categories of indicators used to construct the index decreased from July, and all 4 categories made negative contributions in August. Now, not to worry, the 3-month moving average, well, it ticked up to minus 0.14 from minus 0.15 in July. All it's saying is, indeed, the national economy is slowing down, not at a rapid pace, but the trend here is slowing, and that's not a good sign, because if we have a global banking crisis, you can only imagine this is all going to grind to a halt. And from that, let's head over to China, where we pick up today's headline story. As China seeks to facilitate capital flows to woo foreign investors. And now, why does this matter? And we talked about this because money is leaving China. People don't want it there. Don't want to hold the currency. We're going to talk about this again. But what happens if you essentially take money out of the system? Well, inside the system, businesses and investments that need money, well, some people start to get starved of it. And when they can't get that money they need from the banks or from the system, well, they go into liquidation or default or delinquencies. Bad things start to happen. And that's what's happening in China, and why we're saying it's not going to stop until something breaks. Western firms in China are now the gloomiest they've been in about the future in decades, possibly because they watch this show, as largely due to geopolitical risk, according to a recent survey by the American Chamber of Commerce in Shanghai. Persistent tensions with the West, coupled with China's economic slowdown, has sparked $188 billion exodus from Chinese stocks and bonds from a December 2021 peak through the end of June this year, diminishing the market's clout and global portfolio. That's the key, though. Money leaving the system. And where does that money end up eventually coming? Well, people are looking at the U.S. stock market and say, look, it's unstoppable here. They're looking at the dollar and saying, wow, what a great trade. And it would be for you if you had our CTA-Timer Pro report. Let's pull this up here because it nailed this move on the dollar with perfection. You see this big candlestick here? Well, we run a machine positioning report, and then we do a second historical overlay to give you an advantage over the machines that we've shown you over and over on the show drive the markets. If you would have bought it open here, you would be up 5.4% on the dollar. Many think it's going a lot higher. Here you can see it on our CTA-Timer Pro report. It came off that deep short position on July 25th, triggering what would be a buy it open. If you like, we have our Momentum Timer Pro report that looks at momentum screens. It on July 26th. There you see the dollar picked up the first buy signal. And by the way, we have a special announcement today. Many of you have asked, Steve, will you make Momentum Timer Pro a standalone report? Well, I did. It's $20 a month, promotional price right now, link in the description. And on top of that, the first month, it's on me. All right, let's get back to China here. As we see, it's facing its biggest capital flight in years, creating concern for authorities as it worsens pressure on the beleaguered yuan. The currency has been hammered from all fronts as money leaves the financial markets. Global companies look for China alternatives, and a revival in overseas travel hits services trade. And so one of the challenges here, as the currency loses value, and you're thinking you're holding yuan, well, if you don't want to see your money go down in value, but you need liquidity, well, where would you go? Well, you go to the dollar, because the dollar is not like it's liquid, it's going up in value. And of course, more the dollar goes up, puts downward pressure on the yuan, and at some point, Beijing is forced to answer. And all this captured in the latest official data, which shows an outflow of $49 billion in the capital account last month, the largest since December of 2015, which you might remember is right before we were starting to enter a global synchronized recession. So we're seeing this problem again. But now let's take a look at how it's affecting the property sector, which we know is largely dependent, or at least the banking system is almost entirely dependent on, because if China's property sector goes, and you're going to see it starting now, well, there goes its banking system, and it's only a matter of time before it spreads to the rest of the world. As two of China's strongest developers face ratings cut by Moody's, as Vanke and Yamano are on watch now. Here we can see China Yamano Holdings and China Vanke are facing possible cuts, part of a number of rating actions announced by Moody's on Thursday. Yamano is currently rated as one notch above junk territory, which is not a great place to be, while Vanke is 3 steps into investment grade. The downgrade reviews reflect high uncertainties about their ability to recover weakened credit metrics and financials, quote, amid uncertain recovery prospects for China's property market, in a nice way saying these companies are potentially in big trouble. And remember, we said, where will the big ones go? The other ones will eventually follow. If you see one cockroach, you know in the wall, there's always more. In this case, China's property market's got a ton of them. As their property firms have seen new home sales slump under the past several months, while debt worries involving large builders Country Garden and Sino-Ocean Group have weighed on the market. Moody's lowered its sector outlook to negative on September 14, quote, amid weaker economic growth prospects and homebuyer concerns over timely project completion and delivery, which dampened property sales despite government support measures, which is exactly what we said on the show. We said, look, if these property developers can't get homes finished because they can't get money from the banks because they're running a Ponzi scheme, because in China, as you may recall, when you buy a property there, you pay for it up front. You start making your mortgage payment and then they build it. Where here in America, you don't do it that way. The builder takes out the loan, they take the risk, they build the property, and then you buy it and start making payments, so at least you know you have a home. In China, no guarantee that you're going to get it, particularly if the builder goes bust, and that doesn't inspire confidence in the system at all, no matter how much stimulus Beijing wants to pump into it. In addition to Vanke and Yamano downgraded reviews, the rating firm on Thursday lowered its outlook to negative on 7 other builders. So you have China Resources, China Overseas Land, China Overseas Grand Ocean. I can't say that one. Policy Developments, Shum Yip, and Greentown China, you're facing downgrades because this is what's going to actually happen here, is confidence in these are going down. As they get their ratings downgraded, they need to add more capital into their system. They can't get capital because they don't have any, and you start to see the gears of the Chinese property market grind to a halt, and that means the banking system goes completely insolvent, and we're starting to see it now. Check this out, with Evergrande facing liquidation risk, and this is exactly what happens when systems run out of money after creditor meet is scrapped. A string of surprise developments include scrapping key creditor meetings in the last minute, saying it must revisit its restructuring plan, detention of money management unit staff, and an inability to meet regular qualifications to issue new bonds. Now, this is huge. They need to raise money, so they're going to issue bonds, and now they can't. And that is a huge problem because they got to get this figured out. And if they don't get it figured out in time, they face liquidation, and you can only imagine what that's going to do to the sentiment of the other builders, is how the banks are going to handle it, which they're not, because they're facing insolvency risk if the property developers crumble. Okay, of course, we know that Beijing knows this. Why they're not doing anything is a surprise. The last item is a major setback to its planned restructuring of at least $30 billion of offshore debt that would have creditors swap defaulted notes, so that's not good, for new securities, which would give them hope to getting paid. Evergrande shares plunged as much as 25% on Monday. And the latest signs of trouble at Evergrande caused simmering worries about China's deepening property crisis to flare. As we made the case, where there's one cockroach, there's more. A gauge of Chinese property stocks tumbled the most in 9 months on Monday, taking its loss in valuation this year to $55 billion. And here we can see China Yuan Group slumped by a record after share resumed trading, and property investing firm China Oceanwide Holdings faced court-ordered liquidation after a Bermuda court issued a winding up order. So here you can see the hits keep on coming to the property sector. The banks have to be outright panicking there. You can see this is the nightmare scenario because once the money is gone from the system, it's hard to refill it. You're talking about outright money printing by a central bank. The only question is, will Beijing go that far? The worsening industry crisis has fueled concerns among some global money managers that Chinese assets are becoming uninvestable amid weak governance and disclosure practices. China's offshore junk bonds, most of which were issued by builders and which were once one of the world's most lucrative fixed income trades, has lost more than $127 billion in value since peaking just 2.5 years ago, adding to our view that eventually, at some point, when the system breaks around the world and you'll see it snap, it'll go like dominoes across the world, all the central bankers will be back at zero, and it won't matter. It'll be too little, too late. But despite the fact that they're going back to zero, they don't actually believe it. As Fed's Goolsbee says, soft landing possible, but risks remain. We're going to show you who doesn't believe the Fed at all, and it's not just me. It's quite a few people, as I've been calling it the golden path, and I think it's possible. It's a fantasy more than anything, and there are a lot of risks, and the path, well, it's long and windy. He pointed to the unemployment rate, which at 3.8% last month was still very close to where it was last year, but inflation was more than double what it is now, and the Fed was just embarking on its aggressive tightening campaign, giving us the indication that the Fed thinks this time they got it. There's no way. They don't even realize it was all the leftover pandemic stimulus. It was the fact that student loan repayments were paused. Those are all issues, and now it's going to catch up with them really quick because we know not only is the money gone, but the repayments start next month. As Goolsbee earlier this month said, he and his colleagues are beginning to see progress in the monthly prints of core inflation. He reiterated that the Fed is rapidly approaching the time when the discussion will shift to how long to hold rates high rather than how high it should go, suggesting, in his view, we are near or close to near the terminal rate. And at that point, they want to hold it there for an extended period of time and then bring it down a little bit. What they don't realize is it's too little, it's too late. They've gone too far. They're going to break the whole system at a time, not just with the Chinese banking system is insolvent, but you look at the U.S. banking system or small and mid-sized banks. They are insolvent. By definition, they are insolvent. But the fact is, the Fed believes this outcome. But other than me, well, look who else. The Fed is curbing inflation, but consumers say they're still paying too much. They don't buy into this Fed soft landing. They don't buy the myth that this is going to work. They're still paying too much. And what that means is a further reduction in discretionary spending. So you have less discretionary spending going on. You have credit cards that are maxed out. You have student loan repayments starting in about a week. You have the pandemic stimulus gone. You have all the markers you need to see things start to go wrong in the fourth quarter. China can't see it. The Fed can't see it, but now you can. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.